Nissan showroom looks like a money machine at first glance. Rows of shiny new cars glow under bright showroom lights. Salespeople in sharp suits greet you at the door. Glass walls, polished floors, a giant blue logo out front. It looks like pure profit just waiting to be collected. But almost none of that visible glamour is where the real money hides. Owning a Nissan dealership is one of the most misunderstood businesses in America. Most people assume it's simply about selling cars. In reality, it's about surviving on razor-thin margins and quietly hunting for profit in places customers never notice. Today, we're breaking down the real economics behind owning a Nissan dealership, what it costs to get in, where the money actually flows, and why so many owners struggle. Nissan is one of the most recognized car brands on the planet. It sells everything from budget commuters to full-size trucks. Models like the Sentra, Rogue, and Altima are household names. That built-in recognition brings walk-in customers before you even open. Owning a franchise feels safer than starting a business from zero. You inherit decades of brand trust overnight. Nissan also provides national advertising and marketing support. Many buyers see dealership ownership as a fast track to serious wealth. Multi-location dealer groups can post tens of millions in annual revenue. The idea of becoming a local auto mogul is genuinely tempting. Successful owners often become pillars of their local business community. It feels like a stable, recession-resistant business on the surface, but revenue numbers can be deeply misleading. Big top-line sales don't always mean big profit at the bottom. Getting approved as a Nissan dealer is far from easy. Nissan doesn't hand out franchises to just anyone with money. They dig into your financial history, your experience, and your local market. You need serious liquid capital before they'll even consider your application. Realistic estimates put required liquid capital around $500,000 to $650,000. Total net worth requirements often climb to $1.5 million or more. That's just to be considered for approval. The real spending starts after that. Land in a strong location can cost $1 million to $5 million. Prime spots near highways or busy retail corridors cost even more. Building a showroom to Nissan's exact brand standards adds millions on top. Nissan enforces a strict retail image program for every dealership. Lighting, signage, glass walls, and service bay layout are all dictated by the manufacturer. Owners have very little freedom to design their own building. Deviating from these standards can put your dealer agreement at risk. Then comes the inventory itself. Dealers don't buy their cars outright with cash. They finance their entire inventory through something called floor plan financing. A single Nissan store can carry $2 million to $5 million in vehicles at once. Every day those cars sit unsold. Interest quietly accumulates. That interest is a cost most outsiders never think about. All in, total investment to open a Nissan store often lands between $2 million and $10 million. The exact figure depends on city, land price, and dealership size. Smaller rural stores cost far less than large urban flagship locations. This is why most new Nissan dealers are already wealthy before they start. It's less a small business opportunity and more a capital deployment strategy. Here's where the biggest myth about car dealerships falls apart. New car sales look like the core business from the outside. In reality, new car margins are painfully thin. Dealer markup on a new Nissan is often just 2% to 5% above invoice. On a $30,000 vehicle, that can mean less than $1,000 in gross profit. Sometimes it's even less once discounting begins. So why do manufacturer incentives matter so much? Because they're what actually keeps new car sales worth doing. Holdback is a small percentage of the vehicle's price returned to the dealer later. It usually adds another 1% to 2% back into the deal. Without holdback, many new car sales would barely break even. Volume bonuses from Nissan also reward dealers for hitting sales targets. Miss the target, and that bonus disappears completely. So why sell new cars at all if margins are this thin? Because new car sales create foot traffic, and that traffic feeds three far more profitable departments. The first is used cars and trade-ins. Used vehicles carry noticeably higher margins than new ones. A used car can generate $1,500 to $3,000 or more in gross profit. Trade-ins are especially lucrative because the dealer controls the appraisal price. The second profit engine is financing and insurance. Known as F&I, this includes auto loans, extended warranties, and protection package. F&I products can add $1,000 to $2,500 in profit per vehicle sold. Many dealerships quietly earn more here than on the car sale itself. The third and biggest profit center is the service department. Oil changes, brake jobs, recalls, and routine maintenance keep it running. Service bays typically run at gross margins of 40% to 70%. Every Nissan on the road eventually needs service somewhere. That creates a steady, recurring income stream for years. Owners who bought a Sentra 10 years ago still come back for oil changes. Parts sales add another reliable layer of margin on top. In many stores, service and parts generate the most consistent profit of all. New car sales bring people through the door. Everything after that door is where the dealership actually earns its living. This is the hidden mechanic most customers never see. The showroom is essentially a marketing expense for the service bay behind it. That single idea explains almost everything about dealership economics. It's not a car business, it's a customer relationship business. And that relationship is what turns into decades of profit. Understanding cash flow here matters as much as understanding profit. Floor plan financing means dealers pay interest on unsold inventory every single day. The longer a car sits on the lot, the more that interest eats into profit. This is called aging inventory, and it's a silent killer of margin. A car that sits for 90 days can lose its entire profit to interest alone. Manufacturer incentives change monthly, sometimes even weekly. A model that was profitable last month can flip to break-even overnight. Dealers must constantly adjust pricing to keep pace with Nissan's shifting incentive structure. Miss a shift, and you're suddenly selling cars at a loss. Advertising co-op requirements add another layer of obligation. Nissan requires dealers to spend on marketing that follows strict brand guidelines. This spending isn't optional, it's written into the franchise agreement. Regional advertising pools also pull funds from every local dealer. Add all of this up, and paper margins rarely match real cash in hand. A dealership can show healthy gross profit and still struggle with cash flow. That gap between paper profit and real cash is where many owners get blindsided. Floor plan interest rates rise and fall with the broader economy. When rates climb, that fixed cost quietly grows heavier every month. Few outside the industry realize how much interest rates shape dealer profit. It's one of the most overlooked variables in the entire business. Running a Nissan store costs far more than just buying inventory. Staffing alone includes salespeople, technicians, finance managers, and support staff. Payroll can consume a large share of monthly revenue before profit even shows up. Skilled technicians are especially expensive to hire and retain. Facility upkeep to brand standards isn't a one-time expense either. Nissan periodically requires image upgrades and full remodeling cycles. These upgrades can cost hundreds of thousands of dollars per cycle. Refusing to comply can put your entire franchise agreement at risk. Insurance for inventory, liability, and property adds another heavy monthly cost. A lot full of unsold cars is a serious insurance liability. Utilities for a large glass showroom are far from cheap either. Heating, cooling, and lighting a modern showroom adds up fast. Floor plan interest itself is a recurring, unavoidable cost of doing business. When interest rates rise, this expense rises right along with them. Marketing spend must continue even during slow sales month. You can't simply stop advertising when sales slow down. Software systems, inventory management, and CRM tools add ongoing subscription costs. Property taxes on prime dealership land can be substantial. All of these costs exist whether or not cars are actually selling that month. That's the uncomfortable truth hiding behind every polished showroom. Fixed costs never pause, even when customer traffic does. This constant financial pressure is what separates strong operators from struggling ones. Now here's where the real danger in this business lies. Nissan doesn't guarantee dealers a steady supply of popular vehicles. Allocation of hot-selling models is controlled entirely by the manufacturer. If Nissan sends the wrong mix of vehicles, dealers are simply stuck with them. In recent years, Nissan has faced serious financial turbulence on a global scale. Plant closures and cost-cutting plans have raised real concern among dealers. Talks of a major partnership with Honda collapsed publicly, shaking dealer confidence. When a manufacturer struggles financially, dealer support and allocation can quietly shrink. Past reliability concerns, like widely discussed CVT transmission issues, haven't helped the brand's image. Heavy reliance on incentives has trained buyers to always expect a discount. That habit slowly erodes the brand's long-term pricing power. Nissan has historically leaned on fleet and rental car sales to move volume. Heavy fleet sales can quietly drag down resale values across the lineup. Lower resale value means lower profit when those cars come back as trade-in. The shift toward electric vehicles adds another layer of uncertainty for dealers. Models like the Ariya require entirely different service skills and equipment. Dealers must invest in EV charging infrastructure and technician training. There's no guaranteed payoff timeline for that investment yet. Franchise agreements also include strict termination clauses. Underperforming dealers can lose their franchise rights entirely. Losing exclusivity in your territory can happen if the manufacturer restructures regions. Many owners underestimate just how thin their true margin actually is. A single slow sales month can turn profit into loss almost overnight. Interest rate hikes on floor plan debt can quietly erase net income. This is exactly why so many dealerships lean hard on service departments to survive. Without a strong service bay, a slow sales quarter can be devastating. Some owners pour profits back into facility upgrades just to stay compliant. Others get squeezed between rising costs and stagnant new car margins. Competition from Toyota, Honda, and Hyundai adds constant pricing pressure. Losing even a few points of local market share can hurt badly. Economic downturns hit car sales faster than almost any other retail category. When consumers get nervous, big-ticket purchases are the first thing they delay. All of these pressures combine into one uncomfortable reality. Owning a Nissan dealership carries real financial risk behind the polished exterior. So is owning a Nissan dealership actually a good business to be in? The honest answer is, it depends almost entirely on execution. If you rely only on new car sales, it's a brutal, thin-margin grind. If you build a strong service and F&I operation, it can be genuinely profitable. Location changes everything. Urban markets behave very differently from highway or suburban stores. A dealership near a major highway sees different traffic than one in a quiet suburb. Operator skill often matters more than brand strength alone. Two Nissan stores in the same city can have wildly different profit outcomes. Well-run Nissan dealer groups can post healthy 7- or 8-figure profits every year. Poorly run ones can quietly bleed cash for years before finally failing. Outcomes always depend on country, city, dealership size, and local competition. They also depend heavily on Nissan's own regional allocation decisions. The manufacturer's financial health directly shapes every dealer's future. Real secret isn't the cars sitting in the showroom at all. It's the service bays, the finance office, and the long-term customer relationship. Owning a Nissan dealership isn't really about selling cars. It's about building a recurring revenue machine disguised as a car lot. The showroom draws people in, but the service bay keeps them coming back. That quiet, repeatable cycle is what separates thriving dealers from struggling ones. And that, more than anything, is the real economics behind the brand. What looks like a simple car business is actually something far more complex.